reached out for the greater good of Malaysia. Today, across the country, from cities to townships, we endeavour to serve you, to understand you, to do good by you, to be here for you. At Standard Chartered, we continuously have you on our minds in the things we do and the decisions we make. We create financial solutions that protect you and inspire you to achieve your aspirations. We open gateways for your business to flourish, linking your products and services to markets around ASEAN and the world, connecting you through our global capabilities and local knowledge. We pioneer digital innovations and technology that benefits you and the communities around you. We invest in the potential of our youth, giving them tools and platforms to realize their ambitions. We empower women entrepreneurs because we believe in equal opportunities for all. We champion our environment, protecting resources for our future generations. We excite you with global sponsorships and world-class events promoting health and goodwill.
As Malaysia's first bank, we live by our purpose of driving commerce and prosperity through our unique diversity. For over a century, we played an integral role in driving Malaysia's economy and facilitating trade and investment. We remain relevant through several generations of Malaysians by growing, protecting, and managing their wealth.
Standard Chartered is a truly global bank, but we're also deeply local. We know we've got a fabulous global network. Malaysia is at the heart of that, and our business in Malaysia has always been a fantastic mix of the two, connecting Malaysia to the rest of the world and connecting the rest of the world to Malaysia.
I'm proud of how much we have accomplished for the country, true to our promise of being here for good.
And as our nation prospers, we continue to look forward to be here for you.
Good afternoon, ladies and gentlemen. My name is Mastura Adnan from Standard Chartered Malaysia, and I'm glad to be your host for the session today. Thank you for tuning in to the webinar for Export Excellence Awards 2021. Today's webinar, Digitalisation Opportunities, will be 1.5-hour session. It is also streamed live on Starbee's Facebook page, so thank you for tuning in right now. Do share our Starbee's FB Live with any of your colleagues and friends who are keen to join. All right, a few housekeeping matters before we begin. As everyone dials into this webinar through different internet bandwidth and devices, you may or may not experience minor technical glitches. So please be patient if there's any. To minimize the risk of technical glitch, all participants are muted and video cam turned off by default. Do participate by posting questions to our speakers at any time during the session. On your user panel, click on the Q&A button and post your questions if you are using Zoom, or place it in the comments section if you're watching via FB Live. You can also interact with each other using the chat feature in Zoom or the comments section in Facebook. There will be a short survey at the end, so to those joining us on Zoom, please take a few minutes to complete it. Your opinion matters to us. Lastly, and more importantly, engage, learn, and enjoy the session. Before we begin, allow me to do a quick introduction of Export Excellence Awards. The awards, fondly known as EEA, is into its second year. It is organized by Star Media Group, Berhad in partnership with Standard Chartered Malaysia, together with Martrade as patron and championing the achievements of Malaysia's finest exporters. Through this award, we hope to motivate and inspire businesses to further elevate the awareness of Malaysian brands in the international arena. EEA is more than just celebrating the best of the best in the export award. in the export world. The year-long program from its launch to the roadshows and judging sessions is designed to form a community for the export players. Through this, we are committed to build a fraternity that supports one another, share thought leadership, best practices, and corporate role models. On today's webinar, we will have an interesting session covering various topics. To give an overview, we will begin with an economic outlook for 2021 by Jonathan Koh, Economist Asia from Standard Chartered Bank Singapore. Divya Divesh, Head ASA FX Research from Standard Chartered Bank Singapore, will then be sharing on foreign exchange movement. After that, we will move to the panel discussion on leveraging on technology to elevate your export strategies. And the panelists comprised of Raj Tatavarti, Managing Director, Head of Business Banking, Standard Chartered Malaysia, Jacob Isaac, Managing Director of FusionX, Izham Abdul Hamid, Deputy Director, Digital Trade Section, Transformation and Digital Trade Division, Malaysia External Trade Development or MATRADE. And this will be moderated by Kang Eugene, Chief Operating Officer, Digital and Print Star Media Group. To begin today's session, I would now like to invite Jonathan Koh to share on the economic outlook. In his scope of work, Jonathan provides macroeconomic coverage of Asia, specializing in Singapore, Malaysia, and New Zealand. Over to you, Jonathan.
Thank you, Mas. Hi, everyone. Thanks for having me here. And I think in the next 10 minutes or so, I'll be sharing with you the economic recovery so far in the global economy as well as in Malaysia. Please bear with me while I just share my slides. Okay, I hope you can see my slides. So our title for our Q2 outlook is actually entitled The Uneven Race. And why we actually say that is basically what we are seeing in terms of the economic recovery is uneven in two ways. First, across economies, and second, even within economies itself. Allow me to elaborate more further. Now, the economic recovery actually depends on the speed of the vaccine rollout. And as you can see on the chart on the left-hand side, we actually see that emerging markets clearly lag developed markets in terms of vaccinations. So for example, in North America, the average number of people who have received at least one vaccine dose is almost 20% of the population. And in Europe, it's almost close to 10% or even higher than that. Meanwhile, in Asia, it remains actually below 5%. So this speed of vaccine rollout actually affects how quick governments can actually relax their mobility restrictions and actually enable economic activity to actually flourish. Now, although a lot of the headlines is only on vaccine rollouts, but we also need to take note in terms of how cases are actually performing. And actually, the world has been experiencing waves after waves of COVID-19 infections. And just last week, we actually saw new cases of 5.2 million being added, which is actually a pandemic record. And this is a concern because what this means is that mobility restrictions by the governments have to remain in place for much longer and actually delaying the economic recovery further. So as I mentioned earlier, the global growth is probably going to be strong because of the speed of vaccine rollout and also because of US fiscal stimulus, which is actually massive in scale. I mean, with just 1.9 billion worth of stimulus, 1.9 trillion, sorry, worth of stimulus being announced in the US in Q1 this year. But we are starting to see some unevenness, even from last year itself, where we actually see, for example, China and Taiwan ending 2020 with growth levels that is above pre-COVID levels. However, for the rest of the world, it probably will take some time to return back to end 2019 levels. So in the US, where vaccination is proceeding quite quickly and with huge amount of fiscal stimulus, we are seeing that the US will probably return to end 2019 levels and surpass it by the Q2 of this year. In the Europe, in EU, for example, we are only seeing that probably happening in next year in 2022 itself. For Malaysia, based on our estimates, we think that we will return to end 2019 levels by the end of this year. Now, the growth recovery is predicated on fiscal stimulus actually being loose, fiscal policy being loose, and monetary policy being accommodative. And what that has actually given rise to is concerns over inflation, which has actually been dominating headlines over the past few months. So now, what is actually our view on that? we actually think that inflation concerns are probably overdone and mainly predicated on two reasons. First, we think that supply side pressures have been the main reason for inflation actually being higher, whereby we think that mobility restrictions have actually led to supply side constraints and affected supply chains, thereby leading to supply shortages and therefore higher prices. And secondly, is in terms of pent up demand. Because of mobility restrictions being eased, a lot of the pent up spending that was supposed to be happening during the lockdown period was actually being pent up. So once mobility restrictions are actually being relaxed, consumers actually go out there and spend, and that has actually also led to a surge in inflation, and that's probably one of. Having said, we think that inflation is probably concerns are probably overdone, and we actually see it being subdued, mainly for the reason that we think that the labor market is still some time away from recovering back to full employment levels, and therefore the economy is still operating below potential, and it's probably going to take some time before that negative output gap actually closes, which means that demand pull inflation will probably continue to remain subdued. Now, the other risk that we see to the economic recovery is on the is on the geopolitics front, and more pertinently would be the US and China relationship. I mean, if you recall back in 2019, we actually had the US-China trade war, and I think what COVID also brought about is in terms of relooking at supply chains, whereby a lot of economies and countries are starting to potentially bring some supply chains or bring some manufacturing back to their own countries, and that may mean that global trade may actually come off even further back from the during the further down from the GFC peak, and that's probably not good for ASEAN, which actually depends quite a bit on global trade. And not only on the trade front, but I think in terms of US-China relationships, what we also have to watch is in terms of how Biden is pursuing foreign policy. So he's pursuing it slightly different from Trump, a bit less erratic, but a lot more united together with US allies. So if, let's say, we recall the Xinjiang issue, whereby sanctions were being imposed on China with regards to human rights issue, we actually saw that quite a number of countries, including the US, Canada, UK, EU, etc., actually imposing sanctions on China, and in a matter of hours. So it's pretty much quite coordinated. And this is the first time that the EU has actually done so in 30 years. So I think while we are not expecting an all-out trade war, for example, to happen this year, but we still think that this kind of tensions between the US and China will probably still have to be watched closely, as there could be economic implications, for example, via sanctions. So I think the two key risks here is in terms of inflation leading to monetary policy to potentially become tighter, and geopolitics, which is something to watch out for. Now, allow me to now pivot back to Malaysia. So for Malaysia, this year, we are expecting a full year growth of 5.7%, up from the contraction of minus 5.6% last year. Basically, this rebound is on the back of base effects. And if you look at 2-year growth, actually, it's almost 0% if you basically add both numbers up and divide by 2. And the reason, and the government's forecast is actually between 6 to 7.5%. The reason we are slightly lower than the government's forecast is because of MCO 2.0, whereby originally we were actually forecasting growth above 7%, but we lowered it because of MCO 2.0 in Q1. That being said, we think that the impact this time around from the movement control order is probably much lesser than the first round. And the reasons being that this time around, more economic sectors were allowed to operate, firstly. And secondly, we actually saw that the world is actually not in synchronized lockdown. Thirdly, we actually see that there are already SOPs in place and already support measures in place, and the government announced even further stimulus measures, for example, your Epf withdrawals, which should actually help to cushion the slowdown. And lastly, we have the vaccination program progressing, while slightly slower in Malaysia, but nevertheless, I think the promise of a vaccine will still help to limit the downside in confidence. So in terms of how COVID is like in Malaysia, I'll just go through this quickly since you guys are on the ground, you probably know it much better than me. We have started to see cases come off after the wave in Q1, but we are starting again to see some cases rising, especially in Kelantan. And now we are starting to see daily cases again going above 2,000 cases. However, one thing to note and to highlight this time around is that it's very unlikely that the government will implement a blanket movement control order like they did in the first quarter this year. what they are probably going to do, which they have done in Kelantan, is actually implement a very targeted, localized measures. So, for example, impacting just a number of districts within Kelantan, but actually not implementing a blanket MCO across all states. So I think that will actually help, or rather will not impede economic growth or the economic recovery as much versus a blanket lockdown. So as I mentioned earlier, I think the recovery that we actually see from Malaysia is probably going to be delayed, but we actually don't see it being derailed. So as we can see from the chart here, I think there has already been a recovery with many indicators, your exports, industrial production, wholesale and retail trade, etc., actually picking up ever since the sharp contraction in Q2 last year. But we have the pickup is actually quite modest. So some of these numbers are like wholesale and retail trade are just almost around pre-COVID levels, but not really improving too much above pre-COVID levels. So I think the drag from the continued cases in Malaysia, as well as the slow progress of vaccination, probably means that the recovery is probably going to be quite slow and more prolonged than expected. So it's only going to be a modest recovery this year. Now, what do we think is the main driver, I think, for the recovery? It's going to be from the consumer. I think if we look at the 2 years prior to COVID, so 2018 to 2019, 90% of GDP growth was actually driven by consumer spending, as can be seen from the chart on the left. And therefore, we think that the recovery of the labor market is actually key. Now, in February of this year itself, we see the unemployment rate at 4.8%. It's down from the high of 5.3% in Q2 last year, but it's still way above the pre-COVID levels of just above 3% at around 3.2%. So we actually need a recovery in the labor market to actually help to support consumer spending. There are some measures that we think can actually help to support consumer spending this year. So for example, it's the targeted wage subsidies. Lesser than last year. Last year, close to 20 billion ringgit. This year, probably around 2 billion ringgit in total after the 700 million extension that was announced. But nevertheless, some support. And I think the other key one that is going to really help to boost consumer spending and help to support consumer spending is actually in terms of Epf withdrawals, whereby the government has actually relaxed conditions for Epf withdrawals. So that means more people can actually have access to their Epf funds and actually help to draw them down to actually help support spending. So I think this is where support for consumer spending is going to become from Epf measures as well as fiscal support in terms of wage subsidies. Now, continuing on from the fiscal front, we actually see that the fiscal deficit was being raised to now 6%. Previously in the budget, it was 5.4%. So for 2021. So I mean, if you compare 6% for 2021 versus 6.2% last year, actually there isn't much of a drop. So basically, there's pretty much still substantial fiscal support for the economy this year. And I think one key thing to highlight, which I mentioned, one key thing to highlight is that in addition to consumer spending being a driver, I think investments is also going to be a key driver this year. We have started to see business confidence actually improve in Q4, even though there were infections were starting to rise. And also, we actually see that the government has actually allocated a huge increase, I think almost 38% increase in development expenditure for their 2021 budget. So that should mean investment should start picking up through 2021. We have started to see some signs of a pickup in capital goods imports, which is usually a leading indicator of investments, and we'll continue to monitor that closely. Now, on the monetary policy front, we expect BNM to actually pause for now. The reason being that they are actually quite optimistic on the growth outlook. So they do think that MCO 2.0 has a hit to Q1 growth, but growth should actually continue to pick up from Q2, and with vaccinations taking place, probably the pace will actually even pick up further in H2, which is why even though they lowered their GDP growth forecast, which was previously 6.5 to 7.5, they only lowered it slightly to 6 to 7.5. So only lowering the lower bound only slightly, but still expecting above 6% growth. So pretty optimistic on BNM's front. And in terms of how they see inflation, they see a temporary spike in inflation in Q2, but moderating thereafter. So what this implies is also that monetary policy is likely to stay accommodative, and there's no hurry to tighten because inflationary pressures are probably only temporary for the reasons that I mentioned earlier in the presentation. and therefore can actually continue to remain accommodative, and policy rates can continue to be kept low to support economic growth. And I think very quickly, just last two charts, basically showing how the exports have actually been like, given that this is an exports workshop. So basically this year, I think we see two factors supporting Malaysia's export growth. First is the rebound in commodity prices. That should actually help to support your Malaysia's export growth. For example, Brent oil, crude petroleum exports, petroleum product exports, LNG exports, CPO exports, etc. I think all these have benefited from the rebound in commodity prices, and that should help to support total exports. Now, we also have electronics, which accounts for more than 30% of Malaysia's total exports, which continues to benefit from robust semiconductor demand, which basically is being used in, for example, your auto car productions, where we start seeing that sector actually facing chip shortages and things like that. And Malaysia, I think almost 20% of exports is actually in terms of integrated circuits, so basically your semiconductors, and that should mean that a higher demand for semiconductors will continue to support this electronic sector as well. So I think two key drivers for Malaysia exports growth this year: commodities as well as electronics. And I think with that, I've come to the end of my presentation, and I'll hand it back to Mas.
Thank you, John, for the insightful sharing. If you have any questions for Jonathan, please use the Q&A function in Zoom or the comment section in Facebook. Jonathan will be addressing them after this. And now I would like to welcome Divya Devesh, Head, ASA FX Research, Standard Chartered Bank Singapore, for the next session. Devesh covers Asia FX strategy and provides views on the latest developments in FX markets and recommends trade ideas and hedging strategies for institutional and corporate clients. He is also quoted regularly in the media on financial market developments. Devesh has also been consistently ranked by Bloomberg as the most accurate forecaster for EM Asia FX in the recent years. The floor is yours, Devesh.
Thank you, Mas, and thank you, Jonathan, for that lovely update. Hopefully you can see my screen. If not, please do let me know. What I plan to do over the next 10 minutes or so is sort of lay out some of the main themes that we see for financial markets for the rest of the year, and also our outlook for the ringgit, which I realize is of utmost importance for exporters like you. So maybe I'll start off with the broader global themes that we think are important for this year. The first one that I guess markets have been struggling with is trying to determine whether we are in a global reflation environment or we are in a US exceptionalism environment. Very quickly, what that means is global reflation is the view that everyone is doing well. EM, emerging markets growth improves, but it's a global synchronized growth environment. US exceptionalism, on the other hand, means that it's actually the US which is leading the rest of the world in terms of its growth trajectory, vaccine rollout, growth differentials versus, say, Europe or Japan, and it's US assets outperforming. Unfortunately, for foreign exchange markets, the implications for these two competing forces is quite different. If it is a global reflationary environment, that's usually quite good for emerging market currencies. It's bad for the dollar. But if it's a US exceptionalism environment, it's actually quite good for the dollar, as the first quarter of this year was. Our sense at Standard Chartered is...
Divya, just a short one. We can't seem to see your screen. So are you sharing?
Yes, I am. Let me restart the share. Maybe that will help.
Yeah, so sorry. Yeah.
Yeah, no problem. Thanks for letting me know. Are you able to see the slides or not?
Yeah, we can't seem to see your slides.
How about now?
Actually, we can't see it, but it's okay lah. I think
Still not visible.
does
Okay.
anybody else
Sure,
in Stand Chart have your slides? Maybe we try to.
That's so let me just give me a moment. Let me try one more thing and then we can.
Yeah.
I hope we can fix it.
So for audiences who are tuning in right now, I'm so sorry. Sometimes when we hold sessions like this, we do have some of these technical issues. So yeah, this is the wonders of technology lah. But we try to make do, so please bear with us. Hey, and we are back.
Hey, it works. Yes, we can see it, Divya.
Awesome. Thanks.
Yeah.
Thanks for letting me know, and apologies about that. So I'll just go back to know what are the themes that we were talking about, and we were mainly thinking about these two competing forces of U.S. exceptionalism versus global reflation, and we think there's actually merits in both arguments. At times, I think this year, like we saw in the first quarter, markets will think that it's a period of U.S. exceptionalism and that will support the dollar. But there will also be periods, and I think we're probably in one right now, where markets will probably think it's not just the US, actually everyone is doing quite well. And that will be negative for the dollar. So these two competing forces for the dollar will keep it quite challenging. But I think the dollar broadly will remain range bound. It might be choppy, but it will largely remain trendless. It's not a dollar much higher view or dollar significantly lower view as well. The second factor, which is something that we are also quite focused on, is this rebound in exports that we are seeing in Asia. And Jonathan touched upon it. I mean, commodity exports are doing quite well. Electronics exports are also doing quite well. But what it really means is that to the extent that Asia's exports are doing so strongly at this point, that's actually a positive for Asian currencies, including the Malaysian ringgit. And that's a very strong and stable correlation, which has held over the years. The third factor which we are focused on is, again, the role commodities are playing. If our view on global growth is correct, that it's going to be a strong year for global growth, and also our view on global trade is right, that trade is going to improve quite significantly, that should mean that commodity prices continue to do quite well, as they have been. As I'm sure all of you would realize, commodity prices have had a fantastic year so far, and we think that continues. For Asia, of course, I think the implications are mixed. There are some currencies, likes of ringgit, Sing dollar, Korean won, Indonesian rupiah, which actually benefit when commodity prices rise. But there are other currencies like Indian rupee, Philippine peso, Thai baht, which actually tend to lose when commodity prices rise. So I think that's a sort of a mixed picture coming in from the commodities side of things. Now, in terms of our view on the ringgit, we are actually quite positive on the ringgit. In terms of, just to get the forecasts out of the way, we are targeting dollar ringgit at 4.1 by June. Which we are quite close to those levels right now. But by the end of this year, by December, we are targeting a move in dollar ringgit towards 4. And there's a chance that there's a break of 4 as well at some point between now and the end of the year. So why are we positive on the ringgit, even though the dollar itself is less clear? I think the first thing to note is that ringgit is really quite correlated with global trade. So if global trade is doing well, ringgit tends to do quite well. So what you see in front of you is simple correlation analysis between global trade and the various currencies across Asia. And the one currency which is the most correlated with global trade is actually the Malaysian ringgit. So again, better global trade dynamics should support the ringgit in our view. Commodity prices is something which Jonathan touched upon earlier. Again, as I'm sure all of you are quite well aware of, crude palm oil, LNG prices are really through the roof. And that's really supporting Malaysia's commodity exports. And that again is a positive for the ringgit. The third factor that we are also quite focused on is in valuation terms. It seems to us that the ringgit is quite undervalued. I mean, one technical term that a lot of foreign exchange professionals like to look at is look at the real effective exchange rate, the REER, of any currency. And this is the chart on the right-hand side, which just compares valuations across Asia. And it seems that the ringgit is at this point the most undervalued currency, and it's really an outlier versus the rest of the region. So I think that is beneficial. But in relatively simple terms, I think the other way to look at it is also just look at the real effective exchange rate versus terms of trade for Malaysia. Terms of trade is quite simply put, it's prices of exports versus prices of imports. I.e., as prices of exports rise relative to prices of imports, the terms of trade also rises. And the theory is if your export prices are doing better than your import prices, then your currency should get stronger. And again, you see sort of quite a wide divergence between terms of trade and the real effective exchange rate, suggesting that ringgit has a lot of catch up to do. The final point that I would make before we go on to Q&A session, and please do keep asking us questions. We look forward to some of your questions during that session, is if you look at the Malaysia's FX reserves position, that has improved quite significantly. And this is, I mean, of course, a lot of improvement happened over the course of the last 1 year since March 2020. Net reserves have gone from about, say, 90 billion all the way above 100 billion, which is a key psychological level for markets. But really that trend has started, in early 2019. So for the last 2 years, we have seen a very significant improvement in Malaysia's FX reserves position. And what that means for us is that the central bank will probably not feel the same urgency to keep on buying dollars, given that reserves are already at a 5-year high. So quite a few positive things going on for the ringgit. We do think that dollar ringgit has more downside this year. For exporters, I guess, as I started the presentation, there will be periods of US exceptionalism dominating market sentiment. When you see dollar rise against the ringgit in those scenarios, as we saw in the first quarter, I think those are really opportunities to fade the move up in dollar ringgit. So I think it's probably going to help in trying to time the markets and use these up moves in dollar ringgit to fade, to increase your hedging exposure, because fundamentals wise, I think ringgit looks like it's in a very strong position this year. Maybe I'll pause my initial comments there, and we can go on to the Q&A session now. And I would also invite Jonathan back for the Q&A session.
Thanks, Devesh. Okay, maybe while we are waiting for some questions, maybe I'll ask Devesh first. What is your view in terms of ringgit outperformance versus currencies in the rest of the region?
Yeah, sure, Jonathan. I mean, the way we are thinking about, how we talked about dollar ringgit, but how does ringgit compare with the other regional currencies? I guess the way we are sort of thinking about it is, we are probably dividing Asia into two groups. The group where we think, currencies will actually remain quite strong are those which are export reliant or export dependent currencies. So think about in ASEAN, it would be the likes of Sing dollar and Malaysian ringgit. In North Asia, it would be probably the likes of Korea, Taiwan, and renminbi. So I think these currencies will perform much better. The second group, which we think is probably going to struggle, is the big commodity importers in the region. So the likes of Indian rupee, Indonesia, Thai baht, and Philippine peso. So INR, Thai baht, and Philippine peso. I think these will underperform. So it's sort of a mixed picture. I think ringgit outperforms against INR, peso, and Thai baht, but probably moves in line with Sing dollar, Korean won, and the other North Asian currencies. I also seem to be getting, there's one question for you, Jonathan, which is just come up. So maybe I can ask you that question. And
Sure.
the question is, what do you see is the impact of MCO 2.0 on monetary policy? And as sort of a follow-up to that question as well is how much does the EPF withdrawal actually end up supporting growth in terms of actual figures? I know you mentioned that in your presentation.
Sure, thanks, Devesh. So in terms of MCO 2.0, I think in one of my slides, I also in a way showed that the impact to total spending versus a week ago for MCO 2.0 was just around -5%, whereas for MCO 1.0, it was closer to almost -20% or thereabouts. So I think the impact of MCO 2.0, I think, is much lesser for the reasons I mentioned above, much more prepared to deal with it, less stringent, allowing more economic sectors to actually remain open, etc., as well as the promise of a vaccine. And also, I think as part of the measures being implemented, which you highlighted in terms of EPF, we see EPF adding almost 2 percentage points to GDP growth this year, and that is taking just the figures of I think in terms of total EPF withdrawals, that will come from three fronts. First is in terms of with reduced contributions. So I think the contribution rate has fallen from 11% to 9% for this year. And then we also have the iLestari program, as well as the iSina program. So in total, from these three avenues, we think that the EPF contribution, or rather withdrawals, can be up to 70 billion. And if we just assume that around 50% of that is actually being spent, that may mean almost 2 percentage points growth to 2021 GDP itself. Yep. And I'm seeing some questions also from the audience. In terms of so it's in a way in relation to the US-China trade war, but more relating to the currency front. Do you think that with tensions remaining high, whether exporters should be considering paying with CNY instead? And probably it has to do with the outlook for dollar CNY as well.
Yeah, I mean, I think it actually makes a lot of sense. And Jonathan, you touched on in your presentation as well that US-China tensions will continue. It's not going to be a trade war type of confrontation as we saw during the Trump era, but actually Biden has been going in against China on a number of issues, probably in a more sort of diplomatic way, but certainly a very unified approach in terms of tackling China and its policies. So again, I think the short answer is US-China tensions are here to stay. We do not expect any quick resolution in the coming years as well. So to that extent, I guess it's only a matter of time where the role of renminbi in global trade will keep on increasing. So I think at this point, renminbi's share in global trade is still quite small, but it's a one-way trend. Over the course of the next 5 years, 10 years, I do see renminbi being a lot more internationalized, being accepted a lot more in global trade. And I think the push from Chinese authorities is also towards that direction. They did make an initial push towards that direction a few years back, but when the capital outflow started in 2016, they rolled it back a little bit. But I think once again, they're getting quite comfortable in pushing RMB for global trade. And I think that's probably a long-term trend that we all have to live with.
Thanks, Devesh. If you don't mind, maybe I'll ask you one more question from the audience. I think you previously also touched on the Thai baht during your presentation itself, or during one of the Q&A questions. So, given how do you actually look at the relative performance between Thai baht and the Malaysian ringgit?
Yeah, no, I think actually Thai baht's fundamentals are quite negative in my mind. Tourism is not likely to pick up, and we all know how important tourism is for Thailand and for the Thai baht. So in my mind, it's quite clear that ringgit will continue to outperform Thai baht. Probably for Q2 and Q3, Q4, it's possible that tourism starts to improve and then maybe Thai baht recovers, but that still seems quite a way ahead. Yeah, I mean, I also see sort of one more question for you, Jonathan. Maybe you could help answer that, and that could be our last question probably. There's a question on, is there any concern on the debt ceiling being breached this year? We could take
Sure.
that, Jonathan.
Sure. So in terms of what we see as the estimates for Malaysia's debt to GDP, and I think when we talk about the debt ceiling here, I think let me define it first. So we're actually referring to the statutory debt ceiling, which is basically your Malaysia T-bills plus your MGS as well as your GII. So as of end year last year, I think the debt to GDP ratio was around 58.5% or so, and I think for end of year this year as well, based on the fiscal deficit of 6%, I think the government has mentioned that the debt to GDP ratio is probably going to be 58.5. So this also means that there's actually an additional 1.5% worth of slippage for the fiscal deficit. And given that the government is actually in a way pursuing a more consolidation kind of a fiscal stance, so still substantial fiscal deficit this year, but I think they will probably try to keep it below 6.2% as the economy is already recovering and the situation now isn't as bad as last year. So I think with that 1.5 percentage point buffer, it's quite unlikely that Malaysia will be hitting the debt to GDP ratio ceiling, the debt ceiling of 60% this year. And I think in case some of you are also wondering in terms of how come the debt ceiling remains in a way the same even though there's a rise in debt, one thing to take note is that it's both a function of the numerator as well as the denominator, and this year the GDP, which is the denominator, is going to increase quite significantly. I think nominal GDP itself is probably almost 7 to 8% growth for 2021. Yeah, and I see that Mars has
Thanks, Jonathan.
come
Maybe
off,
we
so
can bring the
Yes.
Q&A. Yeah.
Thank you,
Yes.
Jonathan and Divesh. I believe that's all the time we have for your live Q&A session. But you still get to address your questions in the Q&A session while we move on to the next segment. To continue with our program, I would like to invite Mr. Kang Eugene, Chief Operating Officer of Digital and Print Star Media Group, to take on the panel discussion on leveraging on technology to elevate your export strategies. A little bit background of Eugene. He joined Star Media Group as Group Chief Technology Officer in 2018 to oversee the group's overall strategies and initiatives related to technology and focuses on digital transformation across the group. He was formerly with Hong Leong Bank, OCBC Bank, and M-Bank before taking up a role in Star Media Group. But in November 2019, Eugene was named by International Data Group as one of ASEAN's 50 most innovative technology leaders. Over to you, Eugene.
Okay, hello everyone. Good afternoon and a warm welcome for tuning in to today's panel discussion on digitalization opportunities, the future for export markets. I'm Eugene, as introduced by Mars, and I'm glad to be your moderator for today's very interesting topic. And we have, it's my pleasure to introduce three great panelists, Raj Tatavati, Jacob Isaac, and Itzam Abdul Hamid, right? So just a bit of background on the three fantastic panelists we have today. Raj has more than 19 years of work experience spanning across Asia, Middle East, and Africa. And as an SME expert, for most part of his career, Raj has been involved with small and mid-tier company segment in various capacities, ranging from designing strategy, launching new products, managing credit and operational risk, to heading the overall SME business. He has actually been with Stanchart for more than 15 years and has worked with SMEs across continents in India, Bahrain, Africa, and Singapore. So he currently heads the business banking division of Standard Chartered Malaysia. Now, the second panelist we have today is Jacob Isaac. He is actually the managing director of FusionX Group, which is an established multi-award-winning data technology leader specializing in analytics, big data management, IR 4.0, Internet of Things, machine learning, and artificial intelligence. Jacob has more than a decade's experience in enterprise software project implementation, and he has overseen and been involved in all aspects of big data analytics, AI, trade facilitation, and IR projects, encompassing large volumes of business data and diverse data sources. Now, Encik Itsam, which is our third panelist, has more than 23 years of experience in international trade and export promotion. Currently, he is the Deputy Director of Digital Trade Section and responsible for planning and implementation, responsible for planning and implementing facilitation programs to support Malaysian SMEs in adopting e-commerce and digital marketing for exports. During his 13-year tenure as the Trade Commissioner in Martrade offices in Milan, Cairo, and Istanbul, he has helped Malaysian companies gain market access and exploit international business networking. So three fabulous panelists that we have right now. So I'm sure we'll have a very interesting discussion. So let's begin right away. So just a little bit of background. Digitalisation remains a top priority for the Malaysian government, obviously. In the federal 2021 budget, a total of 242 million, which is US, right, which is about 1 billion ringgit, was allocated in the areas of cyber security, connectivity, Internet of Things or IoT, digital talents, and most importantly, digital transformation of Malaysian SMEs. So overall, the Malaysian budget 2021 is expected to boost Malaysia's critical ICT infrastructure and will positively impact Malaysia's digital economy. Digital technologies are becoming critical for Malaysian businesses trying to remain relevant in the economy and to ensure business continuity for companies moving to support digital work during the pandemic, a trend that definitely will continue post-pandemic, and we can see that happening right now. As such, local companies should view the pandemic situation and the international border closure as an opportunity instead of a barrier to expand their business overseas, and should not be contented with just the domestic market, but rather they should double their efforts to expand their market share elsewhere. Okay, so obviously there's abundance of opportunity to penetrate overseas market, as shown in the trade figures June and July, where exports have actually rebounded strongly, indicating that Malaysia's exports grew about 3% to 92.53 billion ringgit in July 2020, compared to about 89 billion in July 2019. Okay, so that's all the precursor that I have. And now I really want to start the panel discussion. So the first question that I have is actually in terms of evolving technology, right? So if you look at technology adoption and the role of evolving technology, right, it's a start for the digital journey. And COVID-19 obviously has marked the turning point, drastically shifting the needle in digital adoption and transformation among businesses. So against this backdrop, my question is, how has your organization evolved to meet customer needs, demands, and preferences? And as a company built on emerging new tech as big data, analytics, and visualization, what is your view on this? So this is the first question that I want to pose to Jacob from FusionX to understand his view in terms of this, and when and how did FusionX evolve its business model and offerings in response to market changes. So over to you, Jacob, your views, please.
Well, thanks, Eugene. So as a business, we have always been focused on analytics, data, and artificial intelligence. Across the many years, we have evolved quite a bit, as in every business today. So we know that change is inevitable. We know that businesses have to reinvent, they have to re-innovate, and that's just a fact of life, whether we like it or not. And for FusionX, it was the same as well. We started off with enterprise reporting, business intelligence, and then moving on to big data and artificial intelligence. How have we evolved and why did we evolve? Quite simple. When we first started, we were very focused on enterprise reporting, business intelligence, building data warehouses, data marts, producing something of a technical outcome. And that was what businesses were looking for. They were looking for us to help provide them with such data sources, data warehouse, a data mart, dashboards, templates, etc., and to give them something that it's a bit of a sexy look and feel in terms of their reporting. And then we noticed that the climate shifted. They wanted something a bit more predictive, something a bit more forward-looking, and we evolved to produce big data analytics and insights that were very focused on predictive analytics and prescriptive analytics. Today, we have evolved to be something even more efficient, to provide customers with not just the prescription, but also help them action and improve their businesses in terms of increasing revenue or reducing operational costs. So that is what we focus today. So instead of producing a bunch of reports or very sexy looking dashboards, we today provide them with mechanisms and prescriptions, but on top of that, help them to actionize these prescriptions so that they can grow their revenue. And as a result, we will actually be able to benefit from a rev share or profit share model. So that's what we have done across the many years, and we find it to be immensely successful and very rewarding for both our clients, our partners, and ourselves.
Okay, so that was a very comprehensive explanation, Jacob. Thanks for that. Right. So I want to move on and talk about the second question for our panelists. So with digital transformation on the rise, what are common technology adoption trends that you have noticed among businesses that embark on such efforts in the past 1 year? Right. So it's a very generic question. I'll repeat that. With digital transformation on the rise, what are common technology adoption trends that you have noticed among businesses that embark on such efforts in the past 1 year? So I wanted to pose this question to Encik Itsam first, who's from Martrade, because obviously, you know, in your role in Martrade, you will have dealt with a lot of companies, and I'm sure you have a view in terms of what you have seen in terms of some of the tech adoption trends. So Encik Itsam, maybe your views on this, please.
Okay, thank you, Vijay. First of all, thank you very much for the opportunity to be on this panel and participate in this discussion today. So in responding to the question, we have seen during COVID-19 pandemic, many businesses have adopted new technologies, especially leveraging digital platforms to scale up businesses. And what you call prior to the pandemic, online communication platforms like Zoom, WebEx, Microsoft Teams were unknown to most of us. And now we are what you call this platform commonly used by most of us in daily communication and meetings. So we can see by leveraging on digital and online platforms, SMEs can lower their operation costs, increase client supplier base, access business intelligence, services, and also generate economies of scale. So in the context of international trade, digitalization has become crucial for B2B firms, especially small and medium-sized enterprises, which can no longer rely on traditional methods to secure customers and also to conduct cross-border affairs. We also observe that virtual trade shows, B2B meetings and webinars have become alternatives to physical events. So in relation to this, Martrade, being the National Trade Promotion Agency under MITI, has adopted digital initiatives in our export promotion activities to assist Malaysian exporters develop and also expand their export markets. For example, before the pandemic, we would match buyers from all over the world with Malaysian exporters via our signature B2B meetings program, with what we call INSP, or International Sourcing Program. However, due to the International Movement Ban, we converted the B2B into a virtual format, which we named it as eBizMatch. And last year, a total of 1,020 eBizMatch were arranged between Malaysian exporters and foreign buyers, and generating total export sales of 1.08 billion. Another area that we see future growth for export markets is through cross-border e-commerce. This is in line with an upsurge in e-commerce activities both in Malaysia and worldwide. And also with the rise in disruptive technologies such as virtual reality and artificial intelligence has also transformed the e-commerce industry, which not only enhance customer shopping experience, but also improve the business efficiency. In 2019, retail e-commerce sales worldwide were valued at 3.5 trillion and are projected to grow to 6.5 trillion by 2023. So with the ever-increasing size of global e-commerce market, there is no better time for Malaysian SMEs to capitalize on e-commerce platforms to sustain and further accelerate their exports. Last year, we see the number of Malaysian companies adopting e-commerce for exports has doubled, reaching more than 14,000 companies. And talking about cross-border e-commerce opportunities, Martrade, under the 11th Malaysia Plan, we had implemented what we call e-trade program, to assist Malaysian SMEs leverage the power of e-commerce. So basically, this program offers export facilitation to cover part of the onboarding cost for companies joining cross-border e-commerce platform. Typically, we know that companies have to grow large and build up capacity before tackling the export market. However, with the e-trade program, we have many first-time exporters through e-commerce, and they have proven to be successful. Since the program's inception, a total of 3,300 companies have benefited from this program in terms of increased business opportunities, improved brand awareness, as well as enhancing their technical know-how in doing online business. And this program also generated 274 million in actual export sales. And among the top product sectors include prepared food, furniture, lifestyle, halal products, building and construction materials, machinery equipment, and automotive parts and components. So with the e-trade program, SMEs also managed to increase their export revenue and penetrate new markets such as Cambodia, Egypt, Togo, Armenia, and Panama, as well as traditional markets like China, Japan, Australia, Qatar, and the US. So basically, we can see digital platforms and e-commerce have been among the common technologies adopted by businesses during this pandemic. So yeah, basically, at the later part, I will explain about the e-trade 2.0 and how SMEs can benefit from this program. Thank you.
Okay, thank you, Encik Isam. So it looks like the government has a very big push on e-commerce, yeah?
Yes.
Okay, so that was the view from the government's perspective. I wanted to get a view from Raj, right? And in terms of what he sees, because Raj, you deal with a lot of SME clients. So what have you seen in terms of the technology adoption, right? Maybe you're just a slightly different perspective from a bank's view.
Sure. Thank you for that, and good evening to everyone. The onset of pandemic, right? So it has accelerated the whole digital, adoption and the transformation of most of the SMEs. So just to give you a sense, pre-pandemic, on an average within the SME segment, the growth of digital adaptation used to be around 9 to 10%. But during the pandemic in 2020 alone, that adoption rate has increased to north of 25%. So that is a very key statistic which all of us should remember, right? That shows that how quickly and how resilient SMEs were in adopting towards the digital to stay afloat. So that is the first thing which we need to remember. The second one, if you see historically, within B2B, in the SME segment, the adoption rate was higher. In B2C, the digital adaptation was a little bit lower. Whereas during the pandemic, B2C caught up equal to almost B2B in terms of their digital transformation. And the third important point which I would like to highlight here is in terms of the digitization has two aspects to it. The first one is the front-end process. Second one is the back-end process. So if you see, most of the SMEs were very quick and resilient in terms of adopting to the front-end processes. What do I mean by that? Most of the SMEs who did not have a website earlier, they quickly got a website set up. The logistics part of it was set up. So the front-end processes were set up. However, what needs to develop and needs to increase much more faster is the back-end process, which is your inventory management, right? Your data analytics. So these are two of the important aspects of the back-end processes which SMEs need to pick up. And we see that over the last 6 to 8 months, SMEs are focusing more on the back-end also now, over and above the front-end. So these are the changes which I see, especially in the SME segment, which they are adopting.
Okay, thanks, Raj, for your views. I think that's actually quite interesting, right? So, members of the audience, we've got two very interesting views, and which I think that brings us quite nicely to the next question that we have for the panel. And the next question talks about the exponential rise in technology transformation. Obviously speaks volumes in terms of how the mindset of companies have changed. So now instead of being viewed as a cost center, technology is increasingly being seen as an investment for cost optimization and even as an enabler, opening up opportunities for us to innovate, to offer new products and service offerings. So to ensure that they invest in the right technologies moving forward, instead of spending on costly and unwieldy upgrades. Perhaps I wanted to get Jacob to give his perspective, right? When people start spending on technology, what are the key considerations that they should keep in mind when they are spending on technology?
Thanks, Eugene. That's a good question. And that's actually a question I get very, very often. As companies move to digitize their company and their operations and their businesses, they are bound to face challenges and there are loads and loads of considerations. But I won't bore you with all the details. For now, I think what we just need to focus is primarily two considerations. Number one is to ensure the perspective of the initiative is correct and is aligned. I think companies have to be sure that they do not view digitalization as a one-off project. They have to view it as a way of life, as a way of business, something that they will have to plow on day after day, week after week, month after month. They also should not view it as something that is optional. If there is a way out of this, and if they find that they can abandon this project, there's a way to ditch this initiative, then the entire exercise will not be successful. I think they have to view this as something that is inevitable, and there is no choice but to really embrace it and do it well. Even if it takes a bit more time, it takes a bit more budget, it takes a bit more tenacity, it's something which we just have to plow through. So I think the perspective is important. And the analogy is really like if you're a car manufacturer and you've been historically very successful in the gasoline engine, and you are faced with a junction where you want to evolve to have a hybrid engine or an electric engine, I think that's not an option today. It's something which should be considered as mandatory. If you want a business that has longevity, you have to pursue towards that direction. If you want your business to be able to survive for the next 10, 15 years, which I'm sure businesses are looking to survive beyond 10, 15 years because you want to be successful in the long term, not just for the next 3 to 5 years, which can fly very quickly, then it is an inevitable that you have to pursue the realm of hybrid technologies and electric powered technologies for cars, for automotives. So similarly, digitalization for businesses is important and there is no way out. So once you have got the right mindset that this is something that you will have to pursue day after day, month after month, until it is successful, and then continue to enhance, expectations are well managed between stakeholders. If they view it as a hit and run thing and the budget is approved for 200,000, 500,000, 5 million, whatever the figure is, and it's one-off, people will be disappointed. So that's the first consideration, getting stakeholders to fully understand what you're coming on board with, what you're trying to pursue. Second is to make sure that it is sustainable, because whenever you work on an initiative, you have to make sure that it is sustainable across the long term. Again, over here is that you are faced with an option whether to do it in-house or to work with partners outside there. And there are many partners like FusionX to be able to assist you in digitalization. So that is the key consideration. So things like the economies of scale, things like reusable templates and components and experience pursuing such initiatives is what we can offer, is what industry players can offer, and your partners are just at your doorstep to be able to assist you in these initiatives. So instead of hiring like 10 or 15, 20 guys and new pool of talent to create more data sources that creates more headache, as more data that is unmanaged, it's just rubbish. Data that is managed it's actually insights. So creating more silos data sets, creating a talent pool which you cannot retain because youngsters today, they want to pursue the latest technologies. And if you're in the business of creating a product, say in manufacturing, in plastic, or stickers, etc., then it would be very hard to find and retain good talent. Adding to that, you also have cloud hosting costs. So you have computing power, which will cost a lot of money as well. So if you work with partners on this, you are able to leverage on the economies of scale You're able to leverage on their experiences where they have failed and they have found areas of improvement based on their 10, 15 years of experience. And if you're trying to do this on your own and you specialize in manufacturing, for example, or you specialize in retail, you're not a technology player, you will find that the hoops and hurdles are a lot tougher and a lot more challenging and disappointing than what you actually perceive it to be. So having a sustainable plan is very important when you pursue digitalization. So again, not thinking from a short-term perspective, not thinking that we want to have our own resources and our own technologies. That can be sometimes too pricey, especially if you are not a technology player, but trying to claim that you are a lawyer or a doctor. It's like if you have an illness, you would actually look for a doctor. If you need a legal document, you'd probably look for a lawyer as well. So you wouldn't try to be a lawyer and try to be a doctor. So I think that's the analogy of here. So two areas that I think is a key consideration amidst so many other factors, but these two, if you can hold these two well, if you've got a good grasp of these two, you're on the right position. Number one is to make sure that this is something that cannot be viewed as a project, but it's ongoing, it's a part of life. Number two, to make sure that it is sustainable because you know that there are so many different components like computing power, talent, reusable components, technology that evolves every day, and how do you keep abreast with that to constantly not just build those components and build those technological engines, but being able to maintain it, to be able to enhance it as time goes by as well.
That's a fantastic answer, right? Very comprehensive, and I'd like to reflect in terms of the answer that you gave. So basically, we have to take a long-term view, and it's not just a one-off, and it's very inevitable, right? Digitalization is something that you cannot escape. And if I just reflect on my journey at the start, when I arrived here, we were at the starting point of digitalization. We put in quite a bit of effort, right, to actually start improving and create new digital assets, because the writing was on the wall, right? Our readership, number of people buying the physical newspapers is definitely on the decline, right? So you have to go digital. There was absolutely no way around it. And we went with a 3-year roadmap, right? And we're at the end of the 3 years, and we are now, thinking what else to do, right? Because it's a cycle that needs to continue, right? We cannot just stop because improvements are always around. So I like your answer, Jacob. So I want to move on to something else, another question, and this question is: what is the role of technology to help boost export activity? Since this webinar is about exports, right? So I'll just repeat: what's the role of technology that can help to boost export activity and the future of export markets? If you have any views, Jacob, from a FusionX perspective.
Sure, I think that is spot on in terms of the objective. That should be the way moving forward, because we want to have a business that is local, but we don't want to just be jago kampong, right? So we want to expand our businesses across the region and globally. Today it's a very globalized situation. If you want to have a business that can experience longevity, then it's got to be global. Reason being, you're competing not just with the local players, but you're competing with the regional and global players as well. Because if you do not compete with them, unfortunately, they might take the competition to you and they might attack the region that you are very well covered today. So I think in terms of global reach today, technology spoils us with many options, and e-commerce, online stores, marketplaces, some of those options today. And that's, again, an area that we have to pursue. Everyone buys something online. At some point of time, everyone will buy almost everything online. So why not create a new channel? It's just a new line of business. Even if that channel is not immensely successful today, it could be tomorrow. Why not bet on it and bet on it big? Because you know it is the way forward, that eventually everything, whether it's cars, houses, furniture, everything will be transacted online. The new generation are very click friendly. They love to click anything online. And they have faith and confidence in transacting online. So that is definitely the way moving forward. I think that today, a lot of businesses, despite them having great products, great solutions, and great services, they struggle to find new markets. They struggle to reach out to new geographies and new markets. Why? Because expansion is expensive. It's complex, and you have to understand the culture of the locals as well. So if you're going to do that in a very physical approach, in a very offline approach, it could be very, very challenging, time-consuming, and very, very costly as well. But if you do it in the e-commerce way, then you have a business that is 24/7, You're able to reach any geography, anyone can transact and can buy in almost any currency, any payment mode, whether it's the e-wallet, whether it's FPX or credit card. So there's a ton of options, and successful players have proven time and again that they can transact online successfully. So why can't my business do the same? If I'm selling plastic in manufacturing or retail, I could sell across different borders. Again, if you don't do that, your competitors will pursue the same option and they will actually move into your territories. So it's again not an option, but something which we have to do. But fortunately, technology does exactly just that. It breaks down all barriers. So today you're flush with options to either go with marketplaces or to go with your online e-stores. And hey, why not do both? You can actually do both. You can have your own branded online e-store powered by e-commerce engines that are made available today. And you can also work with marketplaces, the likes of Lazada, Shopee, Amazon, etc. So fire all cylinders. It's an omni-channel approach today. Work on multiple channels, but remember, power everything up with big data and AI. Why is that so? Because if it is not data-driven, then your engines can be obsolete, and it will be obsolete at some point of time. What you really want is to create that online portal that's able to reach out to the global society, to reach out to global players and anyone who can be a potential customer. At the same point of time, you want to understand how they navigate your site. What are they clicking, buying, clicking, viewing, and not buying? Where are they dropping off? Are they dropping in the last hurdle at payment, or are they dropping as soon as they see the picture? Maybe pictures don't work. Maybe it's videos that are attractive. Maybe videos is not really working for them. Maybe pictures are more attractive for them. So these are things which, instead of relying on gut feel, you can actually rely on analytics and AI to ensure that your engine is optimized and produces the kind of right content for the right eyeballs to attract them to transact. So online stores that serves you 24/7 reaches out to the globe, powered by AI and analytics that gives you insights to improvise your site time and again, day by day, month and month, to evolve accordingly, is very important. And when you have those two mesh up together, then you have a very competent tool of which you can reach out to the world, to new consumers, to promote your products, your services, or your solutions.
Okay, thanks, Jacob. I have one final question, and this is actually quite interesting, and I'm sure the audience would really love to hear the answers to this. So basically, we talked a lot about digital transformation and what needs to be done. So, for this last question, I wanted to ask Encik Itam first. What initiatives does Matrade have to support businesses' digital transformation initiatives? So, so I want to get Encik Itam to give a view from Matrade, and then maybe later, Raj, you can give a view from a bank's perspective. So, let's start off with Encik Itam first.
Okay, thank you, Eugene. Okay, so, well, as I've mentioned earlier, Matrade has adopted and implemented digital initiatives in our export promotion programs. And this year, we are targeting to engage with more than 13,000 companies through our 334 export promotion programs and export development programs. And our engagement with companies will be focusing on driving Malaysian SMEs as well as mid-tier companies to be more prepared in areas such as sustainability, digital transformation, Internet of Things, and also artificial intelligence, because we know that this plays significant roles in ensuring their success in international business. And we also believe that in the present situation, online platform is also vital for exporters to get connected with potential foreign buyers. And therefore, we encourage Malaysian companies to register as Matrade member and have access to trade inquiries from foreign importers via our online market intelligence platform, MyExport, which allows Malaysian exporters to access real-time key trade information and also market intelligence. So based on the outcome of survey we conducted last year, 53% of the respondents have generated export sales through trade leads in MyExport. So this trade intelligence is updated on a daily basis by our 46 trade officers across the globe. And then in terms of the what you call virtual exhibition. Another major event that will be organized by Matrix this year is the Malaysia International Halal Showcase, or MIHAS. So in light of the COVID-19 pandemic, we'll be organizing for the first time the hybrid edition of MIHAS from 9th to 12th of September, combining virtual and physical exhibition as one complete hybrid event to promote halal business to the world. So MIHAS exhibitors will enjoy this hybrid edition as a complementary feature that can allow them to reach out to bigger audiences and also to expand their networking opportunities. And then on the financial support and incentive, Matrix we have expanded the scope of our market development grant for online export promotion in view of COVID-19 last year. And then the new guideline will allow SMEs to claim certain expenses for participation in virtual trade events to promote exports. So under these new guidelines, eligible companies can apply for reimbursable grant for activities under two categories. One is virtual international trade fairs, and the second one is virtual trade promotion missions where B2B are organized. And then another interesting incentive that we have just launched is eTrade 2.0 program. And this is where an enhancement of eTrade program where we added new features to the program, which include digital marketing and also e-commerce related trainings. So under eTrade 2.0, Malaysian SMEs will be offered two schemes of financial assistance. One is onboarding scheme worth 5,000 ringgit, and the second one is digital marketing and training scheme worth 20,000 ringgit. So through the onboarding scheme, qualified Malaysian SMEs will be eligible to utilize up to 5,000 ringgit in the form of reimbursement for their expenses incurred in onboarding cross-border e-commerce platforms. SMEs are allowed to join multiple platforms under the scheme, allowing them to have more options to choose the e-commerce platforms the best suits their needs and target markets. For example, companies that are involved in FMCG products may choose to onboard B2C platforms, while the manufacturers or suppliers of industrial goods may choose to register with the B2B marketplaces. And then for the DMT scheme, qualified SMEs may claim up to 20,000 for the expenses in conducting digital marketing activities, not limited to, for example, search engine optimization, keyword advertising, social media marketing, and also engaging key opinion leaders to promote their products overseas. And the DMT scheme also covers expenses for e-commerce related training programs. So we believe that eTrade 2.0 will be able to support and facilitate Malaysian SMEs to start exporting via e-commerce and reach out to global consumers. And finally, we would like to encourage more Malaysian SMEs to kickstart their cross-border e-commerce exports by applying for eTrade Program 2.0. And further information is available at our website, www.matrix.gov.my.
Okay, it's a lot of good info there. So I hope everybody was taking notes. If not, if you forgot, just go to the Matrix website. Okay, I think that's the paling sedang. Now I wanted to ask Raj, your opinions, Raj, in terms of what initiatives does a bank like StanChart provide to support businesses' digital transformation?
Sure, thank you. I'll quickly cover this question under three specific parts. How bank is helping the SMEs transform in terms of their digital transformation journey. The first one is, how are we helping the SMEs? That is point number one. And point number two is, in order for us to help customers go digital, we also need to get ourselves digital. That's very important. So what is bank doing in terms of digitization to reach out to the customers in a much more efficient and a faster manner? So that is the second part. And the third one is the financial and the digital literacy part of it. Okay, so quickly under the first part, how are we helping them? We have a state-of-the-art online banking platform called Straight to Bank. So most of the SMEs, especially SMEs involved in export and import, the Straight to Bank online banking platform will help the customers to make and monitor the payments which they are making to their customers 24/7, almost on a real-time basis. Second, and I see this as one of the questions raised in the Q&A, this has got the highest level of security in terms of the encryption, two-factor authentication, because this is one of the most commonly asked SME questions, right? What is the security risk? So the online banking platform which we have a two-factor authentication and the encryption. The payments which are done are also encrypted. So this is what is enabled for SMEs for their day-to-day transactions. The second most important thing is now to encourage SMEs to go to online banking platform. Especially during the 2020-2021, we have started giving a lot of concessions in terms of an SME customer who does online banking transactions, they will get concessions on the TT charges. So if you go to our SME website on Standard Chartered Bank, you can see a program called SME Assist. So I urge all the participant and audience today to have a look at that, which talks about what are the things we are doing to help SMEs to go digital in terms of providing concessions on the online banking platform, etc. And the second part which we are doing is training. So we have, like this webinar, we do very pointed webinars, right? So we don't do a generic webinar. For example, on one webinar, we do focus only on the login passwords. How do you do that? Second one on the payments. If you have to make an international payment, add a beneficiary, how do you get to that? So those kind of webinars for online banking and online literacy, we do very frequently on a monthly basis. And the third and the most important thing, how are we transforming ourselves? So in terms of our credit approval processes, right? Because for us to reach out to the customers and provide them finance as fast as they want, because timing is very important for SMEs, we started digitizing our own internal processes. So we have tied up with local companies, fintech companies who are into AI and intelligence to automate a lot of credit approval processes. So through this, earlier whatever used to take 2 to 3 days, now barely takes hours. Within 2 to 3 hours, we can provide the customer approval. So in a nutshell, so that is what Standard Chartered Bank is doing. One is our online banking platform. Customers can use it for payments. Second is our training programs on online literacy. And third one is our internal transformation itself to go digital.
Okay, thanks. That's a very comprehensive answer. And I just glanced at the time and I think we're running a little bit late. So, but anyway, I think we've had a great panel discussion. We went through the depths of 5 very, very good questions. I want to take a couple of questions if possible from the audience, right? So let's see. What's a good question? I saw one question which I thought was quite relevant, right? And someone actually asked this. So the question was, the automation ecosystem perpetually changes. Okay, so will our constant updating of our processes make it a money pit, right? So digitalization is definitely expensive and we might never be able to catch up. How would we know that enough is enough? So I thought that was a pretty, hard-hitting question, right? Because obviously, if you've ever done any implementation in terms of digitalization, then you have to spend money. So the question is asking, hey, technology is forever improving, right? So after we implement, then something else comes up, right? So when is enough, right? So that's the question. I don't know. Jacob, you want to give your views first?
I think, yeah, sure. So it's a relevant question. Unfortunately, the answer is it's never enough. And hopefully it just gets better and better. Because I think with technology, there's constant improvisations. So you will always have to enhance the processes, whether because there is a change in policy, because there is a better process, or there is a better way to automate the process. At the end of the day, I think the goal should be, if it can be automated, let's automate it. If it can be taken away from the human's decision portfolio, we should do that. So, and maturity counts. And in the very beginning, maybe certain processes, people are not comfortable to automate it because they feel that, oh, that has to be done by a human. And we have seen that time and again, where it has to be first handled by the human. But as time goes by, as the maturity increases and the comfort level improvises as well, I think it's always at some point of time, you'll find that those processes will be automated. As an example, you can see car automation as well. It's something that people are very nervous about, especially the older generation. They will be extremely nervous not to have their hand on the wheel. But surely at some point of time, it will be fully automated, where a certain generation will be very comfortable to have their hands off the wheel and drive all the way from north to south with a fully automated machine. So that is something which cannot be accelerated prematurely, but with time and with budget, I think that should always be the goal. So it will never be enough. And unfortunately, you will always have to invest. And I think every business today, whether you're in banking, financial services, or whether you are an SME, whether you're in retail or online e-commerce, it would be the same, where you will have certain processes. And the goal is to challenge those processes time and again, month after month, quarter after quarter. Can I automate that bit? Can I use a piece of technology and automate that part? Because it looks like it's rather mundane. And today, you can't do it. It doesn't mean that tomorrow you can't pursue it. So it's something which you will have to constantly push the barriers, push the boundaries, and use technology to fulfill those commitments. And of course, that will require more budget, more discussions, and more approvals. But that's how it is. That's the fact of life. And companies that continuously invest in technology will be the companies who can survive. So that's something which we just have to understand, that it is the way moving forward. And as long as we are prepared for it, we have budgeted a certain amount of revenue for that, we'll be in a good place to start.
Okay, thanks, Jacob. I wanted to squeeze in one more short question and see whether it's possible, because it's always good to get the pulse on the ground. And this next question is also quite relevant. So basically the question is asking, hey, is there any advice for a mid-sized company who has limited budget and expertise in terms of what to do with all this fast-paced technological advancement? Right. So again, another hard-hitting, but I think very relevant question. So I want to ask Encik Itham to give his view, because obviously I think Matrade has a lot of great initiatives. So maybe Encik Itham can just give us a view in terms of what can these companies, what kind of assistance they can get.
Okay, thank you, Eugene. Of course, in terms of the assistance and support that Matrade provide for exporters, we cover the whole range of spectrum, from enterprises, small and medium-sized, mid-tier companies, and large corporations. So, for example, like I just mentioned, the market development grant. So it can be applied by also, SMEs. And for mid-tier companies, we have a program, mid-tier development program, where we assist and support mid-sized companies to venture and develop them and venture into export market. And please bear in mind that we also encourage Malaysian companies to leverage on our 46 trade offices worldwide, where they can have on the ground first-hand information on the market intelligence, what's happening there. Perhaps if, let's say, they are looking for potential partners, so they can also be in contact with them.
Okay, thank you. So it's almost 4:30, so I'm going to pass it back to Mastura. But before I do that, I just want to thank all our three panelists. Great insights, fantastic camaraderie, and good responses to tough questions. So thank you very much. And over to you, Mas.
Thank you, everyone, for sending in your questions. And thank you, Eugene, our panelists, for the interesting session. I hope our audience gained some valuable takeaways on tapping into the discussion that we have today. So before we end our session today, please help us to complete the evaluation poll, which will appear on your Zoom screen now. It will help us to improve in future. And if you like to find more about Export Excellence Awards, do go over to exportawards.com.my or click on the link in the chat or comments section below. Once again, our deepest gratitude to all our speakers for taking their time to share at today's webinar, not forgetting everyone for tuning in as well. We hope you have gained insights which are relevant and applicable to you. Look out for more Export Excellence Awards webinars coming to you in the months ahead. That's all the time we have for today's session. Have a pleasant afternoon and stay safe. Thank you.